Welcome back. You're watching Startup Central. Let's now put the spotlight on some developments that are coming in from the IPO street. Well, Physics Wallah's initial public offering has officially made its two founders billionaires. The EdTech giant, backed by Westbridge, set its IPO price band at 103 to 109 per share, valuing the company at a staggering 31,000 crores at the upper end. In fact, the EdTech Unicorn will be launching a 3,480 crore rupees of IPO on November 11th, and it's targeting a 35,500 crores of valuation for the company. In fact, the co-founders will be selling shares worth 380 crore rupees, and the proceeds will fund new centers, leases, subsidiaries, and acquisitions for the company. The company has also released its earnings as well, wherein the FY25 revenue of the company rose to over 2,800 crores, with losses narrowing to 243 crores. In fact, ET Now Sajid Mangad caught up with the company's two founders. Here's an excerpt of that exclusive chat that we had with the founders. Take a look.
Most of these funds are split into opening the new offline centers. A big part is going there, and a big part is going in the branding and the events and the marketing function in the next 3 years. Pratik, can you go deep there?
Close to 200 centers we will be opening in next 3 years. CapEx requirement around those centers, as well as existing leased rental payments and the cloud payments, so that is the current use of proceeds which we have filed for.
You started off online, and then you ventured into offline and hybrid mode over a period of time in the last 5 years. How does this economics of offline work vis-a-vis the online classes?
See, online, we have a very unique model in online, which makes us a very different company. So top of the funnel is social media. We have close to 900 different social media channels, YouTube, Telegram, Instagram, Snapchat, and there we have a community of 12 crore students at this point of time. Online contribution margins as well as EBITDA are very high, because it's a pure platform play where thousands of students study in a one single AI powered classrooms which we have designed over the period of time. Offline, unit economics are very simple. It's a steady state 15 to 18% margin business. But it's a compounding story for next 10 years. Because in online we are the market leaders. We are number 1, number 2, number 3, number 4 players in online. Offline we are number 5th player at this point of time. Having a market share of only 7%. So there is a headroom to a headroom of 93% in offline.
It's interesting that you say that the margins are much higher in online, and then you have ventured into offline market as well. What was the reason for that, given that you had good traction online and students joining you online?
See, mode of learning is not me to decide. I am a service provider. I want to create value in the student's life cycle. Fundamentally, it's a student choice in terms of mode of learning. When we became market leader in online, we ventured into offline, and my offline is not pure play offline. It is tech-enabled offline learning centers which we have designed. And 80% of my offline admissions happens through online. So and decision of opening any new centers decides on how many learner base we have in a one certain pin code. It is not the right comparison in terms of contribution margins of both of these products. My offline should be compared with other offline consumer internet or brands.
18% margin का business is not worth doing. है ना, तो वो कुछ सेंस नहीं बना रहा है. उसको ऑनलाइन से हम कैसे कंपेयर कर सकते हैं? 18% मार्जिन का एक डिफरेंट बिजनेस है, उसकी डिफरेंट ग्रोथ है. या